Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Mario Dattilo. Mario flipped homes for 8 years before he began buying mobile home parks. That was 10 plus years ago. He built a sizable portfolio of mobile home park communities in several states, creating financial opportunities for both himself and others. In addition to his investment company, he owns a mobile home dealership, Celebrate Homes, and other companies in the manufactured housing industry. Mario educates others through his mobile home park investing focused YouTube channel, mariodattilo.tv, and then commercial real estate and entrepreneurship podcast, mariodattiloshow.com, and his real cash flow course and coaching, which teaches future mobile home park investors. So Mario, welcome to the show. I'm going to enjoy this one.
Well, thank you, Keith. As you can't tell, I might be in the mobile home park space a little bit. When you were reading all that, I'm like, yeah, I'm pretty much all in.
Yeah, sounds like it.
All in every area somehow, some way. I never thought I would be in it though, because I didn't know anything about mobile home parks when I first got into real estate. So it's a cool space, as you know. I know you're in the space as well, and it's been extremely profitable. So thanks for having me on the show. I'm looking forward to this conversation. I love sitting down with other guys in my world and just chopping it up. Exactly.
Yeah, we don't always have people on that are in this space, but I certainly is something I'm interested in. So I can't wait to hear your story. Mario, usually what I'll do is I'll start with really your background, where you grew up and what eventually led you to real estate and then the mobile home park space.
Yeah, I grew up in Minnesota and really barely graduated high school. Was heavy into partying, had a really good time in high school. And then when the real world came, and I was turning 18, I realized, man, I do not want to go to college. School just was not my thing. And so some buddies of mine were starting a business, and it was a marketing company. And I checked that out, and I was like, I'd like to work with you guys. And I ended up partnering with them. And we did very well. At age 18, started my first business. I was still technically in high school. And although I was skipping a lot of high school at that point, but I was in and did really well with it for about 3 years. And then the company that we were contracted by to market for filed bankruptcy, and it completely wiped us out. I mean, it was devastating because we'd created all this residual income and we were thinking that we were going to retire by age 22, that was our mindset. And I'm saying that laughing, but I'm serious. We thought we were going to be done. And then when you get cut off, you kind of realize that you're not invincible anymore. But it was actually really good for me because I learned failure very early on in my career. Yeah. And by the age of 21, I had started some other businesses with those same guys. One of them happened to be a real estate brokerage. And I took the lead on that brokerage. And the funny thing is, I'd flipped a few homes And that was about it. So
Uh-huh.
I really didn't have a lot of real estate background. And growing up, I didn't want to be in real estate. My dad was in construction. So in the back of my mind, I always thought real estate was construction, and I'm not
Hmm.
good with my hands. So I was completely not, I wasn't interested in all in the space. But then once I got into the transactional side, I was like, oh, okay, so I don't have to go run around a job site and get dirty. This is cool. So did
Hmm.
well with that for a couple years, and then the market crashed. This is 2008 now. Market's tanking. I'm helping investors buy short sales, foreclosures, all this distress stuff. And I went to my dad and I'm like, construction. I don't know crap about construction, but I do know how to find really good deals for these other guys. I think we should
Yeah.
go buy this stuff ourselves. You do all the construction, I'll do acquisitions, dispositions, everything like that. And if we got to raise some capital, I'm comfortable doing that. And that's what I did. So my dad and I partnered up. We shut down the real estate brokerage and I just went all in on flipping houses from like 2008 to 2000, call it 13, when we started looking at more commercial properties at that point. I mean, I don't know if you're in the space at that time, but the distressed real estate had kind of dried up and now it's going back to boring, having to put out signs and knock on doors and do all the traditional marketing. And that just wasn't fun anymore. So we
Right.
we
Right.
started looking at apartments and didn't find anything, believe it or not. In 2013, I could not find apartments that made financial sense to me, which my expectations were much different than they would be today. Buddy of
Right.
mine brings me a mobile home park deal and looked a lot like an apartment, bought that, and the rest is history.
Yeah, that's awesome.
Yeah.
That's cool. And what caused you to want to shift out of the flipping? Was it just the transactional piece of it, or what?
Yeah, in the beginning I got into it because like, man, we can make a ton of money. This is going to make us rich, right? We're going to build up all this wealth. And then I realized later on, there was one moment that I remember very, very clearly that stood out to me. I was at a real estate investment association, actually a very good one. And the guy who runs it, and a friend of mine comes up to me and we're talking about, residential real estate versus, it was more flipping versus holding was the conversation. And he goes, Mario, how many really wealthy real estate investors do you know that flip houses? Thought about it. I'm like, I mean, I know dudes who make a lot of money. Don't get me wrong. They're in the general scheme of things, they're pretty wealthy. But the wealthiest
Yeah.
people I knew did not flip houses. They all held real estate. And he's like, once you realize that the wealth is created from buying and holding things and not trading them, you're going to get
Mhm.
really, really wealthy. And that's kind of where we're like, this kind of sucks anyways, because we're having to buy and sell all the time. It was really a business more than investing. So trading
For
business is
sure.
what it was. But that's what got me thinking, I want to get stupid wealthy. I don't want to have a job. And so that's kind of what converted my mentality to think bigger and longer term. Single family holds, I never had any interest in that. So it was kind of flipping and then going into larger buy and hold commercial assets is what I wanted to get into.
Okay. Yeah. Fantastic. Well, I guess tell me a little bit about that first one. Where was it, and how many units? Tell me kind of what the makeup was on that.
So, a buddy of mine, commercial banker, calls me up. He knew I was looking for apartments. He goes, "Hey, man, I know you're looking for apartments, but this is kind of like an apartment building. It's in your backyard. It's a mobile home park, and there's a bank locally here that wants to sell the loan. It's a non-performing loan." And I'd bought non-performing debt, quite a bit of it, on the residential side of things. And so I looked at it. I'm like, yeah, this does look a lot like apartments. And I was very comfortable with the complexity of buying debt. And so we did. This was a 57 space mobile home park in Naples, Florida, 2 parcels over from the courthouse. So like really good location. And a lot of people were trying to buy it from the seller who was distressed and they were trying to buy it on a short sale. Problem was, once they'd get into it, they'd realize there was over $1 million worth of code enforcement liens against it. And so that would pretty much wipe it out. The guy owned like $4 something million on it. It wasn't worth that. And then you throw another million plus on top. You couldn't make the numbers work. So by me going in and buying the note, what we did is we put the note under contract. Then I brought in a group that did a lot of construction work and consulting for the county. we all sat down with the code enforcement and zoning and all these other people at the county and said, hey, we're going to wipe you out. All right. We're buying this debt. We're going to foreclose. You're getting wiped out with it, but we're going to make improvements. Let's see how we can work together versus against each other. We don't want you to come in and lean us again, and we'll get it cleaned up. And we put together very specific terms that the county would be comfortable with, and we performed on them. We ended up buying that loan, foreclosed on it, finished off the foreclosure. The bank had started it, and then we went to the borrower. Might be kind of complex for somebody who's maybe new in the space, but we went to the borrower and we said, "Hey, you signed personally on $4.2 million worth of debt. We'll let you off the personal guarantee. Just write us a check." And we ended up getting, six figure. It was about $135,000 over a few checks to get off that loan. So we actually reduced our principal balance, or our basis in that, by about $135K. Our all-in basis was $625,000. Okay.
Wow.
Yeah. And here's the catch.
That's awesome.
This is the crazy part. Anybody who's ever bought any distressed real estate know that the books are usually horrible and it's very difficult to get your head around it. But this was the crazy thing. It was in receivership. So all the financials were court certified financials. So we knew exactly what was happening. It was being eaten up by receivership fees, but it was still very clear what we were buying. And we ended up making a bunch of improvements on that, sold that 5 years later for $6.5 million. So that was
nice.
We sold it for 10 times what we bought it for, which is a pretty crazy deal.
Oh my gosh.
Yeah, it was a home run. I wish every deal was like that, right?
For sure.
Yeah. So that was my first deal. It's pretty hard to match that after that, but it was a good one.
Yeah, I'd say so. Wow.
Yeah.
And so, did you buy another one before that exit, or
Yes.
was it? Yeah. Okay. And so, what did the next one look like?
Yeah, that one was kind of a unique deal and pretty complex. But once we bought that first one, I realized I'm like, keep in mind, this is 2014. So jump back to 2014. Nobody wanted to own a mobile home park. They were trailer parks,
Right.
and they were the ugly redheaded stepchild of real estate. Now they're an accepted asset class, and in the last probably 4 or 5 years, they've gotten to be, an attractive property type that a lot of lenders and owners want to own. But back then they didn't, and so I looked. I'm like, man, this is a really good niche. It's consolidating. The industry's consolidating, and I'm having a hard time finding apartments. This is cool. I loved the lot rent model. And so we just went all in on that. I did buy some self-storage the next year as well. And I've owned storage for just as long, but I've mostly focused on buying mobile home parks after that. The next deal was in Florida. We bought that one off of crazy. We contacted the owner directly and he goes, "Oh, yeah, call my management company." I'm like, "Oh, crap. Here we go. This management company is going to want to have nothing to do with us." And the management company's like, "Oh, yeah, John wants to sell it. Yeah, we'll help you buy it." I'm like, "That's weird. We're not going to have you manage it though." And they're like, "Oh yeah, no, we're just doing them a favor. We don't even want to manage this thing." And it looked like it. Like when you saw the property, they managed pristine mobile home parks, and this one was really rough. And they were kind of doing the guy a favor by not managing it, but managing and charging him. And that one, kind of the unique aspect of it is 79 sites, and they had a bunch of back unpaid balances. We just went and negotiated with all the tenants, and we picked up a ton of the back owed rent that they owed the previous owner within the first 60 days of taking ownership. And there was some nuances to that deal too that I won't bore you with, but every deal is different in this space. If you haven't noticed, I mean, every deal's got some weird hair on it. If you're buying value add type properties, but that's where the riches are. Riches are in the niches, right? And if you can figure out how to solve problems, you can buy things that other people can't figure out. And that's what we've gotten very good at over the last 11 years now.
Yeah. Okay. Well, so what does your portfolio look like now, Mario? Is it as far as the number of parks that you have?
Yeah.
And then in your intro, it said in multiple states? Kind of where all are you invested geographically?
We're in Florida, Georgia, Minnesota, Pennsylvania, and Texas. So we got a heavy concentration in the Southeast in Florida and Georgia. And then the Minnesota, Pennsylvania, and Texas are kind of spotty. They just happen to be, locations that we found good deals in. We're over 1,000 sites, 1,000 lots now. We've got, I want to say we're at like 17 communities. We've done 20, we're buying our 25th 18 communities. We're buying our 25th community or 25th commercial acquisition right now. So pretty exciting. We're at over 75 million in assets.
Yeah, that's fantastic.
Yeah.
And tell me a little bit maybe on those about the financing. Obviously, like you said, that first one was pretty unique in that you're buying the debt. But tell me, I guess, a little bit about financing on some of the others. Have you done any owner financing? Has it always been, you mentioned kind of when you got into the business that it wasn't quite as acceptable to lenders. So it was a little more difficult maybe to find a lender aside from a, local bank that
Sure.
that might be willing to take it on.
Yeah, I mean, typically how we buy these communities is we'll either buy them with seller financing or we'll bring in a bank. Because we're buying value add properties, which means properties that have a lot of improvement to be made to realize their future value or true value, we're typically not going and getting institutional lenders such as, CMBS or agency or life companies, just because they usually like to finance long-term 10-year type loans, and they usually want stabilized properties. And so if we get seller financing, which I'd say a good portion of the properties we bought have been seller financed, but if not, we'll use a local bank. They'll typically finance, anywhere from 65 to 75% loan to value. Sometimes they'll finance in some of the improvement dollars as well. Then what we'll do is we'll get the property stabilized, then, a few years, and then we'll refinance it into that institutional debt that is typically non-recourse, long-term non-recourse debt. We want that off of our personal financial statements, and we want the deal standing on its own with those lenders. And those are really sexy loans. They're typically a 10-year fixed, 30-year amortization, non-recourse, just really good terms. So that's kind of how we do it. And then the equity side, we basically put together capital partners for each deal, and they get a percentage of ownership, preferred rate of return on their money, which is basically like an interest rate on their money that's invested. And we team up and buy it together. So it's pretty fun.
And what about the hold period? What are you typically doing with your investors?
Yep. So we are typically holding for 7 to 10 years. The truth is we're holding indefinitely, but we have to perform it out somehow, right? So I would say most of the deals that we're going to buy are going to be 10 or more years. We have only sold 2 assets, and it was unique situations. That first one, because someone came in with an absolutely crazy price, like I told you, at least it seemed crazy to us. And then the other one was a catastrophic event in a hurricane and a storage facility, and that was a very profitable catastrophic event, but a headache. Those are the only 2 assets we've sold. And other than that, we're really buying them for long-term cash flow. But we're typically refinancing in the first few years after it's stabilized, which is when we target to return the capital to our investors so that they have the least amount of basis, if any basis at all in the deal. And then they get to continue to own it with us indefinitely until we sell it. So to answer your question, we're in it for typically 10 or more years, but we're working to get the capital that the investors put in, our partners put in, as early as possible so that they're just in the deal without any money as well.
Okay. And then as far as the structure with the investors, so you'd mentioned that they were getting kind of a percentage, like a preferred return for the amount that they've invested. And then, when you're refinancing and you're returning capital, are they continuing to get the preferred return on their initial investment or just what they have left in the deal? Just curious.
So there's a bunch of ways to do that, and you're definitely getting in the weeds on it, which is good, because I think people who are looking to participate in these kind of partnerships, they should understand this. So there's kind of a couple different ways to do it. You can either take every distribution that comes out from cash flow and apply that to their capital account. So how much is invested goes down, and it's considered a return of investment versus a return on investment. We don't do that. Well, we do it two different ways, hybrid. Okay, so we do we do it as for operational purposes. All operational distributions from cash flow are considered a return on investment. So their capital account doesn't go down. That's profit for them, right? The reason I said we do it two different ways is for tax purposes. We report it as a return of capital. So then it's a benefit to them from a tax standpoint, which is completely legal, by the way. But we run it both ways. So they're getting it. All distributions are a return on investment operationally, and then for tax purposes, it is a return of capital. Now, all the capital events, such as a refinance or a sale, are always a return of capital, and that reduces their balance. So let me give you a simple example, because I know I just kind of rambled off a bunch of technical things for your listeners. But if you look at it this way, all the cash flow from the property is profit to you. All right. You still, every time you get paid, you still are owed your $100,000, $500,000, $1 million you have invested. Okay. When you refinance, when we return your $100, $500 million, whatever it is, your capital account goes down. You continue to get your profit sharing. Okay. The splits, or we call it a promote. You still get your portion of profits, but there's no preferred rate of return paid to anymore, because you've already received your money back. But every distribution, remember, that you get does not pay down your principal, your capital account. So it's not like we're recalculating the preferred rate of return after each distribution, if that's what you're asking.
And you're right. We kind of went down a little bit of a rabbit hole there, but
you're asking me
it was very interesting
right?
for me. That's right. And then tell me maybe about the dealership as well. One of kind of what my first introduction to this industry, I was in college selling cars. And I too, I always like to say I majored not in whatever it said my major was, but it was mainly partying.
Yeah.
So didn't finish the first go round. I ended up going back and finishing. But that all said, I was selling cars, and we had a good friend of ours from actually high school that was a manager at a mobile home dealership, a CAFCO Homes dealership.
Yeah.
And he recruited me, and he was like, "Man, how much are you making on each one of these cars?" And he's like, "You're going to make a whole lot more if you come, just a little bit down the street and come work for us." So
one of these trailers for me.
Exactly. Hey, I'll tell you what, it was a pretty good position. At that time, they were owned by Syntex Homes. And a lot of the guys that were there were guys that moved over from Palm Harbor, which they kind of had their sales training and stuff down pretty pat. And so I learned a lot, just even from the sales piece of it.
Oh,
so,
I bet.
Yeah.
That the dealership business for us is not a retail. We're not a street dealer, so we're not selling to retail buyers who want to go put it on their own lots. We're a dealership within our communities and other community owners' communities. So we will, as a dealer, we take back homes. Once we've taken back a home through eviction at our community, the home doesn't go into the community's inventory. It goes into our dealership. The dealership then rehabs the home and then sells it to a retail buyer. We have multiple lenders that finance them, and then we retail sale that home back out. Additionally, that dealership will order new homes to bring in and fill lots in our communities. And, we broker homes for our residents as well. So if they want to sell their home, we can help them get a higher price for their home than if they were to sell it, and market it themselves. And then additionally, I've got some community owners who own park-owned homes. They're either rentals or they're just vacant homes, and they're not a dealer, and they're not really set up to market and sell those homes. So we will go in, set up shop, not physically, but we'll set up and start marketing their homes for them. And then we sell them for them, like just like a real estate brokerage would do for a builder or developer, right? So we're marketing their homes, handling all the sales. We help them get set up with lenders and pretty much help orchestrate the sell off of their inventory is what we do. So
Okay.
it's a
Yeah, that's
it's a good
interesting.
supporting business to the community business.
For sure. No, it sounds like it. And so you're working with outside lenders when it comes to that. What tell me a little bit about maybe age limit on homes
Sure.
or what your target as far as something you would be willing to bring into your inventory.
Yeah, I mean, from a financing standpoint, we've got lenders that'll do kind of all different quality levels, anywhere from, I guess you could call them prime lenders that are going to be looking more for the 1990s or newer homes, all the way down to we have a lender that'll finance pretty much anything that that somebody can still live in. Keep in mind, we're backing some of those loans, or we're guaranteeing performance on some of those loans, and so that's why they're willing to maybe go down the quality scale a little bit. If we're willing to back it, they're willing to back us. And so it kind of works that way. But from a quality standpoint, we started out buying used homes, bringing them in and doing that. We've kind of stopped buying used homes to bring them into our communities, only because we've learned that a $3,000 used home that we think is a steal ends up being a $20,000 home and is way behind schedule, is completely unpredictable. There's always surprises, and it's just never what you expect. And believe it or
Yeah.
not, we're set up with some floor plan credit lines and things like that that we can use to order new homes with. Can't use it for the used homes. So it's actually a lot less cash out of pocket for us to buy a brand new $60,000, $55,000 house than it is for us to buy a $5,000 home. It sounds crazy, but that's just the way that the credit line is set up, and it allows us to cover some of our setup costs, and it's actually pretty cool. So we've kind of gotten away from the used home purchases just because it's very unpredictable. Or if we can order 5, 10, 15 homes at a time, then it's scalable, right?
Yeah, yeah, for sure. No, it totally makes sense. I've had my share of the ones that I thought I got first steal and then realized after I was done, finally got a tenant in there. I'm like, holy smokes, how much did I just spend on getting that really up to par and getting it moved into the park and just
Yes.
the whole deal. So,
Yeah, because your cost to move it and your cost to set it up is quite a bit. And then when it
mhm,
gets there, it's an older home, so it's taken a pretty good beating going down the road. Plus the seller didn't tell you about a bunch of things. And then it's very unpredictable. And if you look at it this way, yeah, you're not spending as much on it. But if you're selling it retail like we are, and we're getting cashed out anyways, what do we care? You know what I mean? Like, what do we
right.
care what we're paying for it, as long as it's affordable to the buyer, of course. But it's not like we're renting these homes where we're going to have all this extra cash out for the long haul. We're getting paid off. And so we're just turning money, and it's just cleaner to do it with nice homes. And it improves the community too, versus
For
bringing in
sure.
used homes.
Yeah, no, it makes total sense. And so on the communities that you do have, are they? Tell me a little bit maybe about utilities. Are they primarily city utilities? Are they private? What does that? What does it look like? And maybe it varies
Yeah.
amongst all your communities.
So we have a little bit of everything. I shouldn't say everything. We have a little bit of private, more public utilities. We prefer public utilities just like everybody else, but we own wells. We have some septic. We don't have any wastewater treatment plants or lagoons, but we've done some conversions where we've bought a community that had failing septic and well, and we've went in and ran all new lines, put in and then connected to city. We've done some pretty heavy infrastructure projects that have
Okay,
turned out to be very, very profitable deals. But typically we're trying not to be long-term private utilities, but we do have some. I would say for the most part, well and septic is manageable as long as they're in good condition. Wastewater treatment plant, look, I'm not buying a lagoon unless I could convert it to city. It's just not
Yeah.
it's just not a sewer system that I want to mess with. But wastewater treatment plant, if it was in really good condition or we had enough reserved, to replace it up front, I would still consider buying one of those. I've just never found one that made a whole lot of sense financially. But yeah, I think if you're going to get into the private utility space, you just got to know what you're getting into, because a lot of times people who are new in this industry, they don't know the difference, and they're like, "Oh, this
Right.
is a septic." Or it's a well, and they don't realize that the well requires constant testing and reporting to the Department of, Environment, the DEP, whatever. And there's just more to it, and you are taking some risks. So if you can't manage to the level that you have to manage it, you shouldn't play with it. And especially in the beginning, buying a wastewater treatment plant or a lagoon system, early on in your career, that can wipe you out if something doesn't go right. So I would
For
just
sure.
steer clear of those. Do the properties that are going to have a little bit more predictable infrastructure, and focus on that. It's kind of like this, Keith. A lot of times when people get into mobile home parks, they're just looking for a deal, right? They're like, I don't care as long as it's cheap. Keyword is cheap. They will go after it. And it could be 100 space park with 20 homes in it. It could be, another example would be a wastewater treatment plant, or, well and septic, and the systems aren't working really well. I'm like, no big deal. I'm buying it cheap, right? Well, for your first communities, I would look for deals that are not as heavy of a lift. Light value add is great. I mean, that's the sweet spot. If you can buy things that have pretty predictable upside and, a clear path to stabilization, you're going to probably do very well, and you're not taking nearly the risk. But new investors are often going for the craziest deals because that's what looks cheap. It's like, man, I can buy this 100 space community for, you know, $400,000. It's got 30 homes. It's got 20 homes. And you're like, okay, well, do you realize that you can't refinance that very easily because it's not at the occupancy level? So you're going to have to bring in this many homes to get it to, 80%, 75, 80% occupancy, where you're going to get a good debt on it. Do you realize that your buyer pool for that is going to be minimal? Well, the seller's going to finance me. Of course they're going to finance you. It's because nobody will finance that deal, right? And you've got to spend $1 million, $2 million to buy these homes, bring them in, set them up, which is much more capital and labor intense. And then they get into it and they're like, oh, this is way harder than I thought. And then they get burned out on it. They sell it and they go, I bought mobile home parks. I'll never buy another one again. It's because they bought a deal that they couldn't handle and they didn't know it until they owned it. So it's something that's very, very common. So like the guys and girls that are in my coaching, I always look at it and I go, hey, this looks like a little bit heavier lift than you should be getting into for your first or second deal. I wouldn't touch
Yeah.
that deal 11 years in. You definitely should not touch that deal. And it's probably saved a lot of people a lot of nightmares.
Yeah, I would
Yeah.
imagine. Well, let's maybe talk a little bit about that, because you're in a great position to be somebody that coaches folks. You've been in the business long enough that I'm sure you've seen all kinds of things. What are maybe some of the, just industry wide, what are some of the surprises? Maybe things that when you thought going in, weren't quite as they appeared, or maybe just surprises, lessons that you learned along the way.
Sure. Common one is you got one owner that owns a bunch of homes in a community. That could be a absolute nightmare. That's a huge mistake too, that a lot of owners, and not to go down, different rabbit holes here, but this is also for the people who own communities. Don't let somebody buy a bunch of homes in your community, because it's going to save you the maintenance and the headaches. Because what happens is you get one owner, one investor that comes in and starts buying up homes in your community, and now they control you. So if you want to raise rents and they don't like it, they just say, "Cool, I'll stop paying on 10 homes," and you will quickly comply with whatever they want, because they are basically taking control of your income. And I've seen some sellers sell off their entire portfolio to one guy, their manager. And it's like, oh, it's so great though. You should really embrace this, because this guy takes care of all the homes. I just get lot rent. I'm like, cool. Wait till he gets pissed at you and pulls them all out, because he's making, $700 a month with very little overhead on those homes. He's got money. Like he can pull as many homes out as he wants into the next community who will happily take those. So I've seen that. I've seen, a lot of deferred maintenance items, things that sellers won't tell you about. What I've found is that sellers have very short memory or very poor memory when they're selling you something that they don't want, because we're often buying things from sellers who are in a distressed or motivated situation. They can sometimes, we've had great sellers in most cases, but every once in a while you get a seller who's desperate to sell and they won't tell you about things. So that's where really thorough due diligence comes into play. You've got to really understand why things are doing what they're doing, not just looking at a seller's profit and loss and going, cool, he netted, 150K last year. I'll pay him 1.5 million on a 10 cap. That's, you have to understand what those numbers should look like so you can catch things. I would say some other surprises, utilities are very, very common. We've had sellers lie about occupancy. They'll say that homes are full and they take cash on it. Then you go do your physical inspections and the power's off. It's like, okay, so how long has that guy been there? Call the utility company. That power's been off for 2 years. And so there's ways to fake occupancy that we've seen. There's some tricks to figure that out pretty fast. The electric is obviously a great way to check it. We've seen a lot of issues with, give you an example. Here's one. We caught this in due diligence, but seller, old guy, pretty rough around the edges. And he says, oh yeah, we've got 3 wells. They've been going really well. Everything's fine with them. They run good. Yeah, we had to do this little thing to this, we have to do this little generator. We got to hook up to this, that automatically switches on if the power goes up, but it's good. Works great. We go contact the DEP. We do our own research on it, and he's being sued by the DEP. He just paid $12,000 in fines the previous month and is being, essentially forced out of business if he doesn't comply, which just means getting in a contractor that does well work and fixing it, right? And so we actually bought that deal. We went and figured out everything that the DEP needed, and we were able to nail down prices and costs and bring in a solid contractor. And then we worked with the DEP to get extensions. And then we, immediately after buying it, we went in and made the improvements to it, and it's got a clean bill of health ever since. But, there's things like that. Like he forgot that he was being sued by the DEP and getting fined 12 grand the month before. It's just, again, desperate to sell, but it's a great community. We knew how to solve the problem. And we knew, number one, we caught the problem because we were thorough on our inspections and everything. And then secondly, we knew how to fix it, and we were willing to get in the weeds a bit to correct it before we bought it. The worst thing that you could do is buy that property and say, yeah, I'll fix it when I buy it, or not know about it, buy it. And then you've got to back yourself out of a problem that you didn't know you were getting into. So it's key, if you're going to buy stuff with problems, know about it and know how to fix it before you close. So I would say there's a lot. I'm just trying to think of like other surprises, but pretty much anything and everything you can think of is going to probably come up in these properties, especially because they're so old. There's a lot of times these owners were the original developers of them. And so they've just done everything themselves, which means that other eyes have not been on that property, and you don't really know how they did it and if they followed the rules doing it. And so it's just, again, good due diligence is how you make money and protect yourself. You can make a lot of money with good due diligence, and you can avoid a lot of risk by doing that.
Yeah, for sure. And for your students, you have kind of a step-by-step as far as the due diligence goes, and help walk them through that piece of the puzzle.
Yeah, so we've got a crazy list of on-site, off-site, financial, legal due diligence, physical due diligence, and yes, very thorough checklists, and we go through all that. And what's interesting is I do deal reviews. So if somebody's got a deal that they're working, they bring it to me, I review it with them. I help them kind of look at the deal from an outside perspective and an experienced set of eyes on their deal to make sure that they're not wasting a bunch of their time, number one, looking at crappy deals, but also I can bring up opportunities where I see there's ways to add value, maybe some strategies for negotiating it. And then also, hey, these are some issues I see with this property that you really need to think about or you really need to figure out before you close on this thing. And so, yeah, it's probably one of the biggest values to that group is there's a whole system behind deal reviews for them, which is pretty cool. It I wish I had that when I first got started because I didn't have somebody with any experience in mobile home parks looking at my deals with me. So I had to learn a lot of things the hard way. So,
Yeah, yeah, for sure. I totally get that. And then tell me a little bit about how for the mentorship stuff, it works. I mean, is this all virtual? Is this a local group? What
yeah,
does that look like?
yeah, it's virtual. So I got people all over the country. Actually, last night, I decided that I noticed that some of the new people coming in, actually all of them, when they were bringing me deals, and we have a full underwriting template that they complete when they're modeling out the deals. And I just noticed that there were just some breaks in their understanding of what was going on. And I said, you know what? Let's do just a underwriting extravaganza here one of these nights. I don't like working
Yeah.
at night, but we did it last night from 7 to 10:15 at night. We just like broke out into small this is all virtual by the way. And we broke out into small groups and we just start to finish on this deal. We underwrote the entire deal and we'd break out into small groups. They would look it over with their small group, then they'd come back, we'd talk about it. I'd fill it out for the entire group, answer questions, and it like 3 hours and 15 minutes is no joke at 7 o'clock to 10:15. But it was just something that I felt like they needed. And I think it was, I won't do that regularly because it's brutal. But yeah, I mean, so long story short, it's all virtual up to this point. We'll probably start doing some in-person events later this year, but it's deal reviews. It's an incredible amount of recorded content for training modules, anything and everything. I even bring in my securities attorney to teach securities law and teach about how to raise capital legally and do it the right way and effectively. I brought in, I don't know if you know Gary Harper. He's super big, especially in real estate for business systems. He's a business consultant. I brought him into that where he did a bunch of
Okay.
modules on how to like systemize your business as well. And brought in, yeah. So long story short, I have other guests come in that have very specific expertise that maybe I get advice from them on. And then we do coaching calls weekly on Zoom. I partner with my students. I'm trying to think of all the different things. Oh, yeah, I should know this like the back of my hand, but I don't sell it. So, but anyways, yeah. So it's a very in-depth education. It's basically a college education on buying commercial real estate and mobile home parks specifically.
Okay.
Yeah.
Fantastic. That's neat. And then tell us a little bit more about just what you guys are doing. If our audience, a lot of them are passive investors. A
Mhm.
lot of them they have money in the stock market. Their 401k. Maybe they're not quite as versed in some of these alternative assets. But tell us a little bit about what your company does when it comes to that, and how people can learn more about you.
So you're asking how do we work with capital and partners and investors and all that is what you're asking?
Exactly.
Yeah. So we've got kind of two different capital models that we work in. The equity side of it. So there's, investors similar to a lot of your listeners, they're high net worth investors, highly paid professionals, whatever, that are looking for both, cash flow, appreciation, and also depreciation and tax benefits that they can bring into their overall financial situation. They invest with us, they get equity in the deals, so they get their cash flow, which we talked kind of technically about before, but they get the cash flow, the
Sure.
depreciation. We actually push a, all of our depreciation over to them, so they get maximum depreciation, including we do cost segregation studies to just get as much out of that as possible for them, and then they obviously get the upside on the deal. So when we sell, they're going to be participating in the exit as well. And that's equity ownership. They're limited partners, so they don't have to deal with the management of it. They get to participate, they get to have fun, they get to see the deal happening. But from the sidelines. They don't have to do all the work, but they get to hear about all the crap we're going through, right? And
Right.
and then we also have the debt side of things. So within our dealership, when we're buying homes or we're renovating homes, we often will utilize private debt. These are more short-term commercial loans on the mobile homes themselves. And we use that kind of like how a house flipper would use, a bridge loan or whatever from a private investor. We do the exact same things with our mobile homes. So that we're able to put, investors who need what would rather be a lender and do short term, they get great interest rate and it's secured by the homes. We turn those loans, in a relatively short period of time. So if someone's got a bunch of money, but they're like, in 1 year, 2 years from now, I need that. Sometimes short term debt is a better option for them. But the primary business is bringing capital partners into these communities so that they get to own them with us. So if that's what you're asking, I would say that our typical profile for a capital partner is someone who has some knowledge about real estate. They either came from flipping houses, rentals, whatever, and they're retiring or they kind of want to get out of that, or someone who's been wanting to be in the space for a while but doesn't have the free time to do it. Like I've got doctor friends, lawyers, people like that who make great money. They want to be in real estate, but they're like, yeah, but that's a business. I got to go start in addition to being a full-time practitioner of what really makes them the money. And this is a little tip for this group because I think this might be really beneficial. I have a friend, I always use him as an example. He flips homes right now and he's incredible at it. He's got 0 employees. He does it from outside of the United States. He's in Europe. He flips homes in mostly vacant lots in the United States and makes well over $1 million a year doing it with no employees. And
Wow.
he came to me, he goes, man, I really want to go out and buy, commercial property. I want to buy apartments. I want to buy mobile home parks. I want to buy all this stuff. And I said, why? So, well, I want to build my wealth. I want to, create a net worth. I make all this money, but I'm not really, building anything. It's income for me, and I'm taxed pretty heavy on it. And I said, well, what happens when you start another business? He goes, well, what do you mean? I said, you're starting another business. Like, I can't do what I do on the side at any scale. Yeah, you could buy a couple parks, a few of them, it's fine. But
Right.
at a certain point, it's a real business, right? And I said, what you really should do is do what's making you the crazy money. Who makes $1 million+ by themselves flipping property from, their couch? And I say that, it's not an exaggeration. I said, make the $1 million+ a year, take that capital, go find 1 or 2 great jockeys, 1 or 2 good sponsors who've got a great track record, know what the heck they're doing, know how to operate it, and partner with them. You still get the benefits. Yeah, you don't own the whole thing and you don't get to say that you run all this stuff, but you're making crazy money. Do that and team up with a partner that wants to go run the business. And that's what I would tell your audience is make the money and then put it into these deals, but don't stop what you're doing to go do that. You'll wish you didn't later.
No,
Yeah.
for sure. I've done that many a times where I've jumped into something, and there's always a learning curve, and usually that learning curve has to do with learning through hard knocks and losing money here and there, and it's like, okay, eventually you get the hang of it. But yeah, I always thought that would be the easiest way to get in was just small multifamily, single family, whatever it may be. But at the end of the day, quite honestly, investing passively is the easiest way. You don't have to have that learning curve. Sure, you want to research your sponsor. You want to find, as you said, the jockey that you can place your bet on. But aside from that, yeah, let them handle it and let them worry about the day to day.
And another thing, Keith, on that is people think that starting out small is safe.
Yeah,
but that's not true. That is a bold mistake that people make. They say, you know what? I've got my full-time job. I've got my full-time business. I'm going to just go buy a 10 space, 20 space park and I'm going to get started. I'm going to start small and then I'm going to build up. Do you know how risky a 10 space park is? or a 20 space park is, it's far more risky than buying a 150 space park. What are you talking about, Mario? It's 150 spaces. That's millions of dollars versus, multiple six figures. Well, if you think about it, your diversification across 150 lots is far better than buying 10 lots. Okay. When you have
For
one
sure.
tenant
Yeah.
move out, your occupancy drops by 10%. When you have one person move out of 100 space park, for easy math, your occupancy has dropped 1%. So you just, on a 10 space or a 20 space mobile home park, that one plumbing repair is probably going to wipe out your total cash flow for the month. That one same exact plumbing repair in the 100 or 150 space community, you don't even notice it on the P&L. It's absorbed by the size of that property. And so you're taking a lot more risk by thinking that you're going small, because the expenses have so much more weight on your NOI or your net operating income than they do on the large ones. So I always say, partner with somebody who knows how to do it at a large scale. Unless you want to go and learn it, partner with somebody who wants to do it on a large scale and get into the safer deals, the bigger deals than, the 10 space that is going to be just as hard to buy. It's just as much work to buy the 10 space as the 100 space. And that's not an exaggeration, because you got to do all the same due diligence. It's just,
Right.
you've got a lot more diversification, a lot more cash flow to cover and soften the blows when you do have surprises, because they will come.
Yeah, for sure. No, I think that's great advice. How else can people find out more about you? And then I've got maybe two more questions for you.
Sure. Yeah.
Before we call it a show.
Kind of two different directions, right? You've got the active investor, this person who says, I really want to go out and buy these mobile home parks. I want to sponsor them. I want to raise money. I want to do what you're doing, Mario. I want to buy this stuff, right? Then go to getrealcashflow.com. I can teach you how to do it. All right. And do it the right way. Avoid bumping your head, all that stuff that we talked about. If you're like, hey, I don't have time to do that, but I want to be in those kind of deals, then just go to realestateacq.com. And that's where our investment group is based. And realestateacq.com. And if you're on any of the social media platforms, just find me, Mario Dattilo, putting out a ton of free content. Got the YouTube channel, all of that, where I'm educating for free on how to do this. So if you're kind of like, I don't know if mobile home parks are right, that's where to start. Start at the free level, all the social media, Instagram especially, and then jump in whatever direction, active or passive, you want.
Fantastic. All right, Mario. I've got two questions I ask every guest, and one is, what advice would you give somebody who's maybe just starting out in their investment journey?
I would say, number one, understand what you're investing in. And that might sound cliche, but let me explain. There's a couple different types of investors I see a lot of. Number one, the person who needs to be overeducated. They will study, but they never actually do anything. They fail, okay? Because they don't have the action. They're paralyzed, right? And then you have the other one who goes the other direction. They're like, you know what? I'm going all in on this and I'll figure it out as I go. They fail. Why? Because they make horrible mistakes that could have easily been avoided because they didn't spend the time to understand that they're buying multi-million-dollar assets potentially. If you're going to get into anything, whether it's even a career, you're going to spend the time and the money to properly be educated through college or whatever that training is to be good at it. If you want to make hundreds of thousands or millions of dollars, right? I mean, if you're trying to make 50K a year, 100K a year, you can do that, without in a lot of areas. But if you're really trying to build wealth and make serious money, do it the right way, understand what you're doing. And that doesn't just mean read some books. It means understand the why behind what you're doing. Like last night, I think, I'm talking about this underwriting extravaganza, we'll call it, or it was basically just an extra training that we did that week. But I saw light bulbs turning on. They're like, oh, I'm understanding why these numbers are telling me a story and what that story is now, because we're diving deep into it. You can't just know how to read a P&L. You've got to understand that P&L, and you got to understand that P&L from an operational level so that when things pop up in the numbers, you understand why it's happening. It's going to make you be a much better investor. You'll understand the due diligence side of things. And frankly, if you're going to be a passive investor, you should still understand it at least at a high level so that when you're talking to a sponsor, you said, Keith, vet the sponsor, right? Make sure they know what they're talking about. There's a lot of people that are new in this space. There's very few people who have been in mobile home parks for more than 3 or 4 years, because that's really when it started to get popular. If someone's been investing, in my opinion, for 2 years into something, a year into something, they don't know what they don't know yet, right? So by asking some technical questions, you can quickly figure out, do they know what they're talking about? Like you asked me, how do you handle the capital accounts essentially and all that? Well, it's not an easy answer to that if you understand, if you understand what you're doing, you will know they'll know how to explain it in a very, very clear way and in a very technical way so that you can verify that they're actually going to perform for you and they're not just getting going. So that's my recommendation.
Yeah, for sure. No, it's a great recommendation. And what about a book recommendation? Anything that you've read recently that's been impactful?
Yeah. So there's a few. I would say Never Eat Alone is a very good book. If you've never read that, if someone's never read that, Traction. I mean, our entire business operates on essentially EOS, which is a business operating system. There's one that I just read. Let me pull this up. It was very, very good. And for some reason, I can't think of the name. It's one that I'm going to start recommending to a lot of people. And that is Leadership and Self-Deception is very good. If you've never read that, it's kind of one of those books that really shifts the way you think about something. And it's all around how you interact with people and it's really the book is written for leadership and people in business, but it applies to every area of your life. And it's really how you interact with people and how you treat them and how it affects your business. It's very good. Bible's my number one because I think it transcends both personal and business. But
for sure.
Yeah, there's some. So those are a few recommendations.
Right. Well, in the leadership and self-deception, I have not heard that one yet, so that'll be next on my list. So
I hadn't heard of it either. Yeah. But once you listen to it or read, I did the audiobook. The audiobook's very good. It's a game changer.
Cool. Yeah. Mario, I've enjoyed this. Obviously, it's always good to talk with somebody else in the mobile home park space, and you've got a wealth of information. And so I hope the audience got as much out of it as I did, and really appreciate you being on the Wealth Flow.
Yeah, Keith, thanks for having me on. This has been a lot of fun, and hopefully I was able to add some value as well. Looking forward to doing some more things with you, Keith. This was fun.
Absolutely.
Thanks.
Yeah, thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.